My name is Justin Botti, enrolled agent and owner of Rogue Tax Professionals. Today I'm going to be talking about the benefits of the S Corporation. It's perhaps the most interesting topic of conversation in my opinion. As you know, taxes are a business's number one expense. Granted, depending on the entity, they are passed through the individual, but if you're a sole proprietorship, partnership, S Corporation owner, you're going to be taxed pretty heavily. And then of course there's the C Corporation as well that also pays tax within it. But right now, it's important that I clarify we want to be talking apples and apples. So when you hear people talk about LLCs and LLPs and Incs and those kinds of things, they're talking about a legal entity. The legal entities can only be taxed as a few things: a sole proprietorship, or what they also call a disregarded entity, a partnership, or a corporation. And corporations can come in two sizes: an S corporation or C corporation. Today I'm talking about the S corporation. It is a pass-through entity, meaning that the net income flows through to the individual or the shareholder's personal tax returns via a form called the K-1. Now, if you were a sole proprietorship or a partnership, your net income ends up being subject to not only federal income tax or state income tax, depending on where you're located, but there's also what's called self-employment tax. Self-employment tax is currently 15.3%. Sometimes they drop it down a few percent like they did a few years ago, but it's back up to 15.3% right now. What that is Social Security and Medicare. It takes the place of Social Security and Medicare. So if like you were an employee, you would have a little bit taken out of your paychecks for Social Security and Medicare, and then your employer would contribute Social Security and Medicare a percentage. And that is what the self-employment tax is for business owners. But instead of you paying it, unless you're doing estimated tax payments, which are great to do, you're not taking it out incrementally like you would if you were an employee on the payroll. So at the end of the year, especially new business owners, when they have a good year, they get blindsided by their taxes because they weren't expecting such a heavy tax burden. For example, I love to talk about how I've had several clients who made under $24,000 their first year, and between the federal and the state income taxes and the self-employment tax, they ended up having to pay about 25% of their net income to tax, which they were completely unprepared for because they were barely making above the poverty level. And then once they got done paying those taxes, they were back in the poverty level. So one of the ways to mitigate that, or to get a little bit of tax savings, is to elect an S corporation status and be taxed as an S corporation. And so you can be an LLC being taxed as an S corporation, or you could be a corporation being taxed as an S corporation. But either way, the tax savings is better there. Now, with an S corporation, you wear two hats. You're the owner and you're the employee. So technically, you are required to pay yourself a reasonable wage. So if you are perhaps in a tradesperson and you are making $60,000 a year, and you need to be paying some sort of reasonable wage, say like you do drywall or something like that, and the average wage for a person who is doing drywall is $15 an hour. You need to pay yourself $15 an hour. Now, here's the thing: is you've got your income, then you've got your payroll that you're paying yourself, the officer payroll. You can deduct that from your income, and then what you're left over with after your overhead and other expenses is net income. Now that net income flows through your personal tax return, but the nice thing about that net income is it's not subject to self-employment tax. It's not subject to the 15.3%. So say like you're for an easy way of explaining, say you make $60,000 a year as a person who puts drywall up, and you pay yourself $30,000 in payroll, which you're going to pay Medicare and Social Security tax on to the tune of 15%. So for that $30,000, you're going to probably pay about $4,500 worth of self-employment tax or payroll tax. Now, the other $30,000 is going to pass through on your K-1 onto your personal tax return, and it's going to be taxed at regular income tax, federal and state income tax, but it's not subject to self-employment tax, which would save you ultimately $4,500. So if you made $60,000 as a sole proprietorship or partnership, you're going to pay the full $9,000 on that $60,000. $9,000 in self-employment tax only. That doesn't include your federal and your income. So that's when a lot of times when you're a sole proprietorship or your partnership and you're making pretty good money, you end up paying a lot in taxes. It can be 40% between income and federal and self-employment tax. So the S corporation gives you a little bit of ability to take money out of your business and make money without it being subject to self-employment tax. There are whole caveats to it, like for example, you're technically out of compliance if you don't do payroll, and if you're expecting something like earned income credit and you don't do payroll through that business, it's that corporation income is considered a passive income, and it's not considered earned income, and so you wouldn't be able to get the earned income credit. So for small business owners, switching over to an S corporation may not be the best thing to do right out of the gate. But of course, you wouldn't get that benefit if you didn't have children anyway. So if you're like a hairdresser or a dog groomer or something like that, and you're getting low wages, then doing an S corp election for you might not be a bad thing to save you a few $1,000s on that money you're gonna have to pay in tax.